Hello everyone, my name is Mark Jarvis and I'm a visiting professor at Manchester Metropolitan University in the Accounting, Finance and Banking department. So welcome to the April webinar, which is part of a series of webinars which looks at the UK economy as well as some global issues. This month we look at, of course, the continuing pandemic, then a look at the UK's GDP performance and comparing that to China. We dig a little deeper into central bank digital currencies, or CBDCs as they're being known, and a cursory snap view of cybercrime, which of course links nicely back to CBDCs. Then an update on what big corporates are thinking about the future of work, before turning to an interesting new subject called the cannabis market and the likelihood that 2021 will be a big year for this sector. Despite the ongoing coverage in the news, I think it's worth pausing for a moment and looking at the new cases of COVID-19 around the world and the frightening escalation in India, which I'm sure you've read about. This slide puts it into perspective. Whereas we can see the UK has flattened out and Italy and France are growing quite strongly, along with Germany, countries like Iran. Brazil we've read about for a number of weeks, but this almost vertical upturn by India is a very frightening proposition, frightening escalation, and certainly our hearts go out to the people there. Whilst the UK is handling the pandemic very well with a mixture of vaccine controls, other countries are struggling, and with India joining the UK's red list, as you probably read, you can see from this graph why. So what it means is whilst we are almost relaxing a little bit here in the UK, the world has still got a long way to go. So let's move back to the UK economy, which grew a little bit in February by 0.4%. Moving to this slide here. This followed a revised fall of 2.2% in January 2021. Of course, restrictions were in place to varying degrees across all four nations of the UK throughout January and February, and this is reflected here. The output approach to GDP shows that February's level is almost 8% below the effects of the COVID-19 seen in February 2020, and over 3% below the initial recovery peak back in October last year. Overall, main sectors of GDP remain below their pandemic levels, but only services remains notably lower than the initial recovery peak back in October 2020. Output growth in the services sector was broadly flat in February, as coronavirus restrictions, of course, remain largely unchanged. This follows negative 2.5% growth in January. And overall in February, consumer-facing services were nearly 19% below pre-pandemic levels back in February last year, while all other services were around 7% below pre-pandemic levels. So the production sector did, however, grow in February by 1%. This was mainly because of manufacturing output picking up for the first time since November in places like vehicles and trailers and distribution equipment. The construction sector saw growth of nearly 2% in February, driven by both new work and repair and maintenance. But the good news, of course, is that Deutsche Bank has upgraded its forecast for the UK economy following a revision from the Office of National Statistics, ONS. Deutsche said it expects GDP this year at 6% up. Although 6%, a growth, that means 0.3% up, although its quarterly growth profile remains unchanged in its shape. The revision is actually 1 percentage point above the Bank of England's projection and 1.3% above Bloomberg. So given the lower base and faster roadmap out of lockdown with the success of the vaccine program, the UK is really now poised to grow a lot faster than its peers in 2021. Deutsche went on to say that beyond H1, half one 2021, they do remain cautious. I think that's because they still see some structural headwinds from the unwinding of the employment support from COVID and some Brexit effects, which are clearly coming through on the supply side. So without doubt, some temporary economic scarring is likely beyond summer, with households and businesses adjusting to a new normal in terms of social consumption and working practices. Continuing the GDP look across the world, if we have a look across to China, there is a very different picture. The Chinese economy continued its recovery in the first quarter of 2021 as GDP growth accelerated to the fastest rate on record. According to the National Bureau of Stats of China, the country's GDP grew by 18.3% year on year in the 3 months ended 31st of March. Comparing the latest jump to previous quarters is a bit misleading, perhaps, as the coronavirus lockdown hit the Chinese economy with full force in Q1 2020, so lowering the baseline for the latest reading. Nevertheless, the latest uptick more than made up for last year's slump, bringing average first quarter growth back up to 5% for the past 2 years. In the first 3 months of 2020, the coronavirus outbreak resulted in the first quarterly GDP decline in decades for the world's second largest economy. And whilst the swift rebound resulted in 2.3% growth for the entirety of 2020, this is still equivalent to the worst result since 1976 for this notoriously booming economy. Nevertheless, the pace of China's recovery exceeded expectations of the IMF and World Bank had predicted. China's economic output has declined by nearly 7% year on year in the first 3 months of 2020 after the outbreak in Wuhan. Prior to the lockdown, China's economic growth had stabilized around 6%, following a gradual slowdown from more than 10% growth in the first decade of the 21st century. Staying in China for a moment, we have now seen the launch of the first major economy to issue digital currency. The Chinese government has begun to issue blockchain-powered digital currency to its citizens. 750,000 recipients have been determined by a lottery system and can already spend their digital yuan in stores and online using a special app. App-based payments, I think, are already very common in Chinese retail businesses. So merchants were quick to adapt to the government's new offer. Starbucks, McDonald's are reportedly among those already accepting the digital yuan, as is the Chinese Communist Party. Ubiquitous digital payments and tight government surveillance has led to a plethora of payment data already available to Chinese administrators. This knowledge on how people spend money will only grow with the implementation of the digital yuan, even though the country's central bank has said it will limit traceability and create what it calls controllable anonymity. With the launch of the digital currency, even every yuan in circulation will exist as physical or as digital currency. So analysts expect the Chinese government to raise the amount of digital currency in the future, thereby lowering the amount of physical currency available in the market. Some even think China plans to make all yuan digital at one point. Now, China is not the only country doing this, and indeed is not the first. It is the second country, the first major economy, but the first was the sand dollar of the Bahamas Central Bank. launched last year and was already being accepted in stores in the capital Nassau. We see South Africa, India, Pakistan, and Thailand with concrete plans to launch their own official cryptocurrencies soon. Like some other phone payments, official block payment currencies have the ability to reach the unbanked, making them an interesting development in the developing world. So back to the UK for the second, and the UK Treasury and the Bank of England have established a Central Bank Digital Currency Task Force to coordinate the exploration of a potential UK CBDC, Central Bank Digital Currency. The purpose of the task force is to ensure a strategic approach to and promote close coordination between the UK authorities as they explore CBDC. The task force is co-chaired by the Deputy Director of the Bank of England, John Cunliffe, and HM Treasury's Director General of Financial Services, Catherine Braddock. Rishi Sunak told the Bank of England to look at the case for a new Bitcoin, or CBDC, aimed at tackling some of the challenges posed by cryptocurrencies as a whole, such as Bitcoin. A BOE-backed digital version of sterling would potentially allow businesses and consumers to hold accounts directly with the bank and to sidestep others when making payments, upending the lender's role in the financial system. As our earlier slide shows, other central banks are also looking into whether to set up digital versions of their own currencies, essentially widening access to central bank funds, which only commercial banks can use at present. This could speed up domestic and foreign payments and reduce financial stability risks. Last week, the European Central Bank said it was studying an electronic form of cash to complement banknotes and coins, but any launch, I think, will still be several years away. Bank of England Governor Andrew Bailey has previously said Bitcoin, best known cryptocurrency, fails to act as a stable store of value or an efficient way to make transactions, making it ill-suited to serve as a currency and a risky bet for investors. Central banks have also taken a dim view of efforts by Facebook to set up its own digital currency. Even so, cryptocurrencies have received growing interest from mainstream financial institutions, and Bitcoin hit a record high of nearly $65,000 on April 14th, up 10-fold in the space of the year. Staying with the UK for a moment, and a quick look at dark trading. Rishi Sunak, launching the UK FinTech Week conference, announced other measures aimed at maintaining the post-Brexit competitiveness of London, which vies with New York to be the world's largest financial centre. Since Britain's departure from the European Union, the financial sector has faced restrictions on serving EU customers. Sunak proposed removing restrictions inherited from the EU, including who can trade shares in London and the double volume cap. Now, this would help Britain attract more dark or anonymous trading by big investors after Amsterdam toppled London's as Europe's top share trading centre in January. The Chancellor said the consultation process aims to deliver a rule book that's fair, outcomes-based, and supports competitiveness, whilst ensuring the UK maintains the highest regulatory standards. He also said Britain would propose changes to companies' share prospectuses to enable the rules are not overly burdensome. Of course, the more cyber solutions we have, the more cyber crime there is. Personal data of hundreds of millions of Facebook users have been posted to an online forum recently, and the data includes profile names, Facebook IDs, phone numbers, and in some cases email addresses from 533 million users in 106 countries, and stems from an attack dating back to 2019. Facebook has addressed the issue in a blog post, saying the data was obtained by scraping publicly available data from the platform rather than by hacking into its system. The perpetrators used a feature designed to help users find their friends on Facebook by importing phone numbers from their contacts, exploiting a loophole that has since been closed, according to Facebook. So whilst Facebook pointed out the leaked data did not include financial information or passwords. It's important to note that structured data sets tying users to email addresses and phone numbers are a feast for scammers, spammers, and the other types of internet criminals. Sharing a slide with you for a second here. According to a recent FBI report on internet crime, 250,000 Americans fell victim to phishing, and smishing attacks last year, making it the most common type of cybercrime. With identity theft and spoofing also high on the list of common offences, protecting personal data from getting into the wrong hands is a crucial part in the fight against online crime. And cryptocurrencies need to get their act super tight if it is to be mainstreamed. So back to more of the daily grind and working from the office or not. During 2020, looking at this slide, which I'm about to share with you, the hours worked by home workers changed. In the early part of the pandemic, home workers tended to keep hours close to typical office hours. However, by September 2020, home working schedules had shifted later, and home workers were more likely to work in the evenings compared with those who work away from home. Home workers had much lower sickness rate in 2020. The sickness rate, absence rate for workers doing any work from home was 0.9% on average, compared with 2.2% for those who never worked from home in their main job. In 2020, people worked from home worked more hours of unpaid overtime than those who never worked from home, around 6 hours compared with 3.6. There are many different views of what the next iteration of work will look like. HSBC is moving more than 1,200 staff in Britain to permanent working from home contracts, in one of the strongest indications yet of how banks are locking in changes to employees' work patterns as a result of the pandemic to cut costs. Around 70% of the bank's 1,800 call centre staff base across England, Wales and Scotland have volunteered to never return to the office. Scores of companies have quickly cemented hybrid working and cut office space, but HSBC's move to base some staff permanently at home goes further than most rivals operating for a mixed approach. Such changes could lead to well-being concerns long-term if not handled properly. HSBC has offered staff a £300 per year working from home top-up payment to cover additional expenses such as higher heating and electricity bills. A quarter of staff declined the offer as they wanted to work in the office at least some of the time, while 5% preferred to go back to the office permanently. The future of work at Citigroup will be hybrid. Chief Executive Jane Fraser told staffers recently that most of them will be expected to be in the office only 3 days a week when the world emerges from the pandemic. The memo makes Citigroup the first major bank to declare that a physical presence in its offices won't be required in the post-pandemic world, a change many bankers would have scoffed at a year or even months ago. Ms. Fraser, who took over as CEO earlier this month, said that the plans as to which roles would be hybrid haven't been finalised. Some roles would still require in-person attendance as the norm, and few will change to full-time remote. While some companies have announced plans to shift to permanent work from home roles and hybrid arrangements, banks have largely resisted. But Ms. Fraser said physical offices remain an important tool to promote collaboration, facilitate apprenticeships, and help unify teams. But Ms. Fraser also spelled out some other workplace changes. She banned internal Zoom meetings on Friday to ease the drudgery of video calls. Video calls with clients, of course, can still take place. Equally, and closer to home, the Big Four are adjusting their plans, and KPMG have already committed to a hybrid model. The output of this can be seen in Manchester, where they have told staff it will shut its Manchester Tech Centre because a shift to hybrid working after the pandemic means it will need less office space. The closure of the Manchester side is the latest example of a Big Four consultancy decreasing its office space as employers cut costs and adapt to the hybrid working model. KPMG announced in February that it will invest 44 million in technology and reconfigure its office to include more meeting areas, part of a permanent shift towards employees splitting their time between home and the office. KPMG also said that when considering the plan for the future, when hybrid working is fully up and running, it's clear that we will not need as much space as we currently have. Importantly, there will be no job losses in Manchester, just to a move to a hybrid model. So finally, I wanted to talk about an unusual topic, certainly for this series of webinars, and that is cannabis stock, and are cannabis stock poised to light up? Well, after the US House passed the Marijuana Opportunity, Reinvestment and Expungement Act in December, paving the way for federal decriminalization of cannabis, and Democrats took control of the Senate in the Georgia runoffs, it looks like 2021 could be a big year for the cannabis industry. According to the National Conference of State Legislators, 15 states and 3 territories have legalized adult use of cannabis. Despite the strides made towards legislation of marijuana in recent years, the industry behind it has struggled to meet investors' high expectations. But the mood within the industry is more buoyant with this announcement. And of course, things like the Tilray-Aphria merger further fueling a year-end rally for cannabis stocks. As this chart shows, 2021 is off to a good start for cannabis stocks, with each of the 5 companies considered here posting significant gains in the first 2 trading weeks of the year. However, the City of London also appears to be embarking on a cannabis revolution, with regulations easing across the London Stock Exchange. British MS Treatment Company and cannabis stock GW Pharmaceuticals was a pioneer in this regard, but it is delisting from AIM, and the high-profile $7 billion takeover by Jazz Pharmaceuticals has essentially removed its prominence in the UK. This does, however, illustrate how large institutions across the pharmaceuticals industry are recognizing the validity of the sector, and a demand for UK cannabis stocks is now mounting both from retailers and institutional investors. As a further example, Cannabis Group share price surged on IPO. Its share price rocketed over 170% of the day and continues to rise over 120% the next few days. Furthermore, the current Mayor of London plans to launch a review looking at decriminalizing cannabis. This could spell good times ahead for global cannabis stocks, but we have an election here on May the 5th, so we'll have to see where that goes. Whilst a considerable majority, 63% of London, are in favour of legalising and regulating cannabis, only 19 are opposed to relaxing the rules. But for sure, demand for UK cannabis stock is on the rise. Even major players like FTSE company Associated British Foods have skin in the game. Their company, which owns fast fashion retailer Primark, is among the UK's largest legal cannabis producers. It grows cannabis specifically bred to produce a CBD, a non-psychoactive substance. The UK's legal cannabis market is predicted to top 2 billion by 2024, according to cannabis-focused consultancy Prohibition Partners. So with this in mind, legalization could well become a substantial income for the government, as it has in other jurisdictions. For example, Colorado in the US legalized recreational marijuana in 2012, and the tax benefits from this are already very compelling. The state collected more than $380 million in tax revenue in 2020. For the US as a whole, legal cannabis sales hit a 17.5 billion record in sales in 2020, up 46% from 2019. Now the US appears to be heading towards full legalization. Following in the US footsteps is certainly an enticing proposition for the UK as it seeks to boost tax revenue in the wake of the COVID-19 crisis and Brexit. Proactive investors analyst Alistair Ford has even predicted that legalisation is a likely response to the UK's economic shortfall, let's say, following the pandemic. After all, legalisation would present an entirely new tax avenue for the government. A report by the Taxpayers Alliance has shown that legalisation could potentially mean a £900 million per year saving for the government on policing, prisons and courts. Let's see. I'm Mark Jarvis and thank you for listening.
You last second. Yeah.